of our paper. First, why this topic and why now? It is out of recognition that public banks remain important across the world, despite waves of privatization, for a variety of reasons. They may be the fruit of a particular economic or political philosophy, or perhaps the legacy of the nationalization of weak banks, or perhaps vehicles meant to promote financial inclusion or overcome market failure, such as a lack of credit for long-term projects or for specific regions and sectors. During the COVID-19 pandemic, many governments also relied on public banks to act counter-cyclically and boost credit to households and firms in the face of retrenchment by private banks. How to safely integrate public banks into post-COVID recovery efforts is a very important topic. The safety and soundness of public banks not only is a fiscal imperative, but also matters for financial stability, for several reasons. One, persistent weaknesses in the operations and balance sheets of public banks distort financial markets and may both impede the flow of credit and threaten financial stability. These weaknesses are often the result of political interference and policy goals that conflict with financial viability. Two, doubts about the solvency of sovereign can erode confidence in public banks and cause depositor flight, potentially leading to a broader loss of confidence in the banking system, while weaknesses in the governance and/or credit underwriting practices of public banks pose a clear risk to financial resources. And finally, public banks' privileged access to certain markets or to funding can undermine private banks' returns and provide incentive for risky behavior across the system. Although building effective regulation, supervision, and crisis management frameworks for public banks is as important for financial stability as it is in the case of private banks, this issue has not received the attention it deserves so far. Our recent paper aims to fill this gap, highlighting challenges and discussing how risks can be mitigated. Today, we will wade into these issues. Before going further, let me clarify what we mean by public banks. We take a wide view. A public bank encompasses any bank owned partially or fully by the government. On one end of the spectrum are non-deposit-taking development banks that are set up to address specific market failure or promote certain public policy goals, funded by wholesale borrowings. These typically engage in second-tier lending or provide subsidies to commercial banks. On the other end of the spectrum are government-owned commercial banks that compete with other banks in the same markets and same products, funded primarily by retail deposits. In reality, most public banks lie somewhere in between these two extremes. Some development banks have retail businesses, and some state-owned commercial banks pursue policy objectives. A key takeaway of our analysis is that public banks that directly compete with private banks and take deposits from the public should be subject to the same expectations and requirements of governance, regulation, supervision, and crisis management as private banks. But this is more easily said than done. Insights from IMF surveillance and technical assistance suggest that the challenges remain substantial. There are often carve-outs in law or regulation for public banks. And even when regulation is the same, in practice, supervision and enforcement may be challenged by conflicting supervisory mandates and lack of autonomy. Partly as a result, supervisors or resolution authorities may be slower to take action against public banks in the face of distress or even insolvency. Explicit or implicit guarantees also constrain the options available in the event of bank failure, in addition to unleveling the playing field. In our paper, we suggest that mitigating the risks to financial stability posed by public banks requires a comprehensive policy response that includes enhanced focus across several areas. First, legal mandates, ownership arrangements, and governance structure that safeguard against political intervention. Second, a legal and regulatory framework that ensures a level playing field across all banks independent of ownership. Third, supervisory powers and tools that ensure that public banks' risk-taking is commensurate with their ability to manage risks. And fourth, equal treatment with respect to both the privileges and responsibilities of banks. Public banks should be full members of deposit insurance system, be subject to the same resolution powers as private banks, and not be given preferential treatment with regard to emergency liquidity assistance. And last but not least, greater autonomy along with accountability for supervisory and resolution authorities. I look forward to discussing these issues and policy priorities going forward with our distinguished panelists today. Now let me turn to our panelists for their views. To start, it might be useful if our panelists could briefly describe the public banks operating in your home country and your experiences. Let me start with Viral. You have been Deputy Governor of Reserve Bank of India, whose banking sector has long been dominated by public sector banks. Do you think we should be concerned about public banks from a financial stability perspective? And if so, why? Please.
Yes, thank you so much, Libo. I'll make 3 points. You've touched upon several of them directly or indirectly. First, in India, by statute, the regulation of public sector banks is different. Why is that? Because when private banks get into trouble, the central bank, the Reserve Bank of India, has rights such as the prompt corrective action, for example, not just to put some restrictions on activities of these banks, but actually to undertake a transfer of ownership. Now, as you can imagine, with public sector banks, with government being one of the large owners, such transfer of ownership cannot be done by the central bank without sort of agreement or approval of the government. In India, the law explicitly prohibits this. To me, this is the source of all the problems. If there was any clearly market discipline on public sector banks won't be great. There's greater confidence in the sovereign backing of a public sector bank than there is on deposits of private banks. So the level playing field is already a bit skewed, in my opinion, the moment you attach the government's name or the government's backing to an entity. However, at least if regulators were able to substitute for the market discipline with efficient sales, transfer of ownership, transfer of management in India, even transfer of management has to happen by the finance ministry rather than the central bank if a fraud has been detected or the bank has gone rogue with its making, etc. So to me, this is a fundamental distortion. The fact that there isn't a level playing field, not just in market discipline, but that the laws actually prevent that in happening even from the regulatory side. The second point I want to make is that India did not have these banks forever. Most of the banks in India were private until late 60s and 70s. Uh, there was one large state-owned bank, but everything else was actually a private bank in India. These banks were nationalized by fiat through two big rounds of nationalization. There was no weakness in the banking system at that time. If you read the history carefully, the nationalization happened purely for political gains. The government at that time wanted to have its own foot soldiers in every state of India. And the easiest way to get these foot soldiers was to directly control the branches of banks, because then you could extend credit, pump prime the economy. It was sold to people in the name of financial inclusion. It was marketed to people in the name of private banks, primarily crim skimming and lending mostly to the large industrial houses. While both of these were true, it's not the case in the 50 years of India's nationalization that great dividends were delivered on this front. Biggest wave of financial inclusion in India has happened post demonetization when everyone had to create bank accounts to launder their money. And second, with the advent of digital banking and digital payments, which has made it very easy for people to use bank accounts and other forms of payments to undertake transactions. And second, the biggest wave of non performing assets problem that India has had historically was in the last decade. And if you look at that carefully, the primary source there is public sector banks lending to the large industrial houses of the country. So, precisely what was the rationale for nationalizing private banks into public sector banks, which is to take them away from lending to large industrial houses and let them focus on financial inclusion? India has gone full circle as far as not meeting the stated objectives is concerned. Let me then just make my last point, which is perhaps slightly different than the one you made, which is that my observation in India is that because a big chunk of Indian banking is state owned by assets, probably about two-thirds by deposits, maybe around the same number, but incrementally on deposits is only about 20%. Private banks are gaining major share of incremental deposit from public sector banks. Nevertheless, public sector banking is a large behemoth because of their legacy size of the assets and deposits. Now, what that creates, unfortunately, is that certain rules and regulations of the banking sector have to be uniform. I'll give an example. You can't have an accounting standard for banks which is differential between public sector banks and private banks. Why has India not adopted the IFRS accounting system? Why has India not adopted expected credit loss provisioning? Why has India not adopted accelerated provisioning standards which don't backload provisions after defaults and NPAs have been recognized? The source of all of these problems is the fact that there is lack of capital to put into public sector banks. Government doesn't want to use its kitty or the purse to support public sector banks, even though they are performing its functions in a variety of ways. And this now is a big negative spillover to the rest of the system. Indian private banks, therefore, are also not maintaining the highest accounting standards because they are not subject to them. Because public sector banks get away with certain kinds of extraordinarily delayed provisioning standards to generate similar capital performance, return on equity, etc., private banks often resort to the same practices. This is not to say that all problems in private banks are entirely due to the presence of public sector banks. I'm merely highlighting the point that there's a race to the bottom in the regulation of the entire banking sector because there are concessions to be made to public sector banks. And to me, this is the biggest problem in many ways. The fact that it's not just that you run a weak part of the banking system, but the banking regulator, be it the central bank or a different supervisor, in case of India, it's uniform, it's the Reserve Bank of India, they have to essentially run a weak banking system, and you are just constantly doing patchwork because you are never actually able to or allowed to regulate the banking system, including its private parts, in a manner that would actually be fitting for a modern economy. I think to me, these are some of the core issues which I see as problems for the public banking system. I have not been inherently for or against them. In most of India, it's a historical accident that there are public sector banks. There's no other reason for it. But every time I've looked at data, every time I've looked at the economic forces that are at play in the financial sector of India, uh, to me, this is a huge taxpayer loss. Taxpayers in India are running a huge negative account because of the presence of public sector banks. And I think any gains that can be brought to the table, such as creation of bank accounts for financial inclusion, I'm never able to put the attribute the success of it squarely at the doorsteps of public sector banks. It's happened coincident with a move like demonetization or the advent of digital payments and banking in India. So I've constantly pushed in India to reform these banks, improve their governance, and then as a last step, hand over the ownership to the private sector. It seems it's possible to have banking crises even with private banks. So why take on the additional burden of running this through massive taxpayer losses? Let me stop there, and I can touch upon some of these and other points in detail during the panel.
Thank you, Viro. That's a very informative intervention. Just one quick comment, which is that I think adequately capitalized banks, including public banks, are very important. I think in that regard, if we compare the Indian banks against the Chinese banks, I think one thing that China did relatively better is in terms of capitalizing the public banks in the last 20 years, and in that regard, it's a big contrast between these two countries. Jonathan, you have a long career in public service with multiple roles in financial institution regulation and crisis management, and you have written on the future of state-owned banks. What do you think are the main challenges in ensuring public banks to be safe and sound? Please.
Thank you, and good morning, all. And let me say as background, while I've worked for a number of years in the U.S. in banking supervision, the U.S. does not typically have state-owned banks. While we support virtually every sector of the U.S. economy through some type of government support, it takes the form of tax credits or federal loan guarantees or direct loans by federal agencies. The only time that the U.S. has taken an ownership position in a deposit-taking commercial bank is when the bank is troubled. One exception was during the global financial crisis, the 2007-2008, when the U.S. government lent money to private banks on a short-term basis to help the banks boost their capital position. But this capital support program included built-in incentives to encourage the banks to repay these loans promptly. Okay, so what do I think are the main challenges in ensuring public banks are safe and sound? And I think in your opening remarks, Chairman, you covered much of this. First, often public banks are created to serve unmet needs in the credit markets. Examples might be expanding access to credit in rural areas and to the unbanked portion of the population, or supporting a cyclical sector such as agriculture. One challenge that occurs is if the government has not explicitly provided financial support to these state-owned banks, either in the form of annual subsidies or loan guarantees, to offset the risks of such policy lending. Often public banks may experience higher than normal loss rates, resulting in high NPLs and weak earnings. This may not be due to mismanagement by the public bank, but rather the higher risk nature of the bank's business models. Second, it may be difficult to attract qualified people to run the public banks and to serve on the boards of public banks. Government banks may face limits on compensation. They may be restricted in what they can pay management and directors. There may be limited incentive pay tied to performance. This makes it difficult for public banks to attract and retain experienced bank managers and boards of directors with diverse but relevant experience. This particular governance challenge is not unique to publicly owned banks, but government rules governing compensation and a tendency to appoint people to the bank based on political considerations rather than relevant experience may make it more difficult to build the type of financial expertise required, particularly in a large, complex, state-owned bank. Third, and this is described very well in the paper, the application of prudential supervision and regulation to public banks is often a challenge. Conceptually, the prudential rules and supervisory standards applied to private banks should also be equally applied to state-owned banks. But supervision of politically connected, large private banks has always been difficult. Applying such rules to state-owned banks is even more difficult. Supervisors may experience pushback from bank management who are appointed by government. Supervisors may be reluctant to criticize lending practices that have been previously endorsed by government officials. The application of prudential rules related to loan concentrations and requirements that risks be diversified may conflict with the policy objectives of the banks. How does a bank set up to support local farmers avoid concentration risk? There may also be times when government wants to promote additional credit to counter a slowing economy, even as borrowers are beginning to struggle to pay back existing loans. And finally, again, while these challenges often arise when supervising private banks, it may be more difficult when supervisors are attempting to change the policies of a state-owned bank. Thank you. That's my initial comments on this topic.
Thank you, Jonathan. Indeed, I mean, the challenges that you listed, we do observe such challenges in many countries that have a significant public banking sector. Let me turn to Alexandre. Now, I want to turn to your experience. You have a broad experience as the chief representative for Americas at the BIS, and also as former governor of Bank of Brazil. Your country also has a sizable state ownership in the financial sector, both commercial banks and specialized financial institutions. The policy mandates of public banks vary a lot, and the paper urges countries to work to clarify these mandates. Can policy mandates be consistent with bank soundness? And what are the respective roles of supervisors and government as bank shareholder in this area? Please.
Thank you very much for inviting me to be here today. And let me start by commending the IMF and the staff, the authors of this report. I think this is a very useful guide to strengthen the supervisory process by improving how the supervisors handle this important segment of some jurisdiction, which is the public banks. I will focus here though on public commercial banks, as the paper, I think, the focus is on the retail deposit taking institutions. So I think indeed, to answer to your question, policy mandates can be consistent with bank soundness, and indeed I think it's extremely important to ensure that they are, and that the public banks are properly regulated, as it's argued by this document. In my country, as you mentioned, Brazil, I think we have moved a long way towards encapsulating the public banks into the blanket of the regulatory and the supervisory process, along the same lines as we do have for the private banks. To have an idea, the number of public commercial banks today is a fraction of what it used to be in the 1990s. So Brazil, as you may know, is a federative republic with 26 states and the federal district. But in mid-1990s, we had 33 state-level public commercial banks. So we had more public commercial banks at the state level than the number of states in Brazil. So public banks then serve as commercial lenders, as you know, but they were also the underwriters of state bonds. So they were a relevant source of off-budget liabilities for the state, the local governments, in the case of Brazil. As part of the major fiscal overhaul that Brazil went through between the mid-1990s and early 2000s, the number of state-level public banks fell dramatically. 17 of those 33 banks were privatized, 11 banks were extinguished, and the remaining 5 state-level public commercial banks are subject to the same regulatory blanket, including resolution and governance procedures, as any other private commercial bank. So the question here, I think we need to concentrate on the 2 federal commercial public banks, namely Banco do Brasil and Caixa Econômica Federal. These are much larger and thus more important issue than the few remaining state-level public commercial banks. But these 2 banks are also supervised using the same principles applied to private banks. As the excellent paper states, and in your introductory remarks, I think we must have this public bank subject to the same regulatory structure as private sector competitors, have the same intensity and stringency of supervision, be subject to the same robust governance requirements as private banks of similar size, fall under the coverage of deposit insurance, and pay levies comparable to those charged to the private sector, and have the same access to crisis resolution tools and under the same terms as private sector banks. In 2015, I was still at the realm of the Central Bank of Brazil, which is also the regulator and supervisor of the banking system. The Brazilian Federal Accounting Court audited the Central Bank of Brazil's supervisory process for these 2 banks that I mentioned, the 2 federal commercial banks in Brazil. And the conclusions were 2. One, that the supervision on the main systemic public banks was indeed equivalent to that of private commercial banks of similar size and importance. And 2, that the central bank was as well equipped to identify changes in the financial conditions of public banks as it will do for comparable private commercial banks. So while I fully agree with this judgment of the accounting courts back in 2015, I think there is at least one regulatory gap that I had to live with, first as deputy governor in charge of financial system regulation between 2006 and 2010, and then as governor till 2016. And this gap has to do with governance, in particular the appointment and dismissal of board members and top management. These appointments were made by the government, specifically by the Ministry of Finance, like along the same lines as Viral just mentioned in the case of India. And they were not subject to the fit and proper assessment of the supervisor. The problem applied only to these two large federal public banks because, as I mentioned before, for the 5 state-level commercial banks, the whole regulatory and supervisory blanket applies in equal terms as the private banks, including for governance purpose and appointment and dismissal procedures. So I think this gap is relevant, as my predecessor here in this debate mentioned. I think the supervisory authority simply cannot make up for weak governance in the banking system. This applies to private banks, and even more so to the case of public banks. So amongst the recommendations made in the report, I think clear definition of mandate, separation between the role of government as a shareholder and as a manager, and the capacity of the bank to manage properly its own risks are fundamental, and I fully subscribe to these 3 recommendations. So I stop here and come back to the debate later on. Thank you.
Thank you, Alexandre. Very interesting experience from Brazil. I think the fact that the state-level state-owned commercial banks, fell dramatically in late 90s and early 21st century, I think show that it is a very challenging job to manage state-owned banks well, both from a regulatory perspective and also from a shareholder perspective. Teresa, Thailand experienced a temporary increase in state ownership in the banking system during the Asian financial crisis, and has a number of specialized financial institutions. Our paper stressed the critical role of greater autonomy in the supervisory and resolution authorities so that they can carry out their responsibilities over public banks. What do you think are the most important challenges here? Please.
Thank you very much, Libo. Well, it's a pleasure to join this panel, with a very distinguished panelist. Thank you very much for the question, but let me briefly talk about the public banks in Thailand, just as a context. We have 6 specialized financial institutions with special mandates. And out of these 6, in fact, only 5 are deposit taking. They are, for example, agriculture banks, and as the name shows, it makes loans to the agriculture sector. We have the government housing bank, government saving bank, and also the SME banks, for example. There is one commercial bank that was the outcome of nationalization after the crisis. And it was also used as well. We had a number of small crises before the Asian crisis. And that bank was also used as a vehicle in absorbing other failed institutions, failed banks in all the following crises. But it is now considered a full-fledged commercial bank, and we consider it, it's like a private commercial bank and supervised in exactly the same way as any commercial bank. So when we talk about public banks in Thailand, our focus is more or less on the specialized financial institutions. These specialized financial institutions account for about 15% of the total financial sector assets, which is not a whole lot. But they certainly have very important roles to play. And they came under the supervision of the Bank of Thailand only a few years ago. We don't have a full range of the supervisory power on these public banks. For example, the chair of these banks will be appointed by the government without having to get the prior approval from the Bank of Thailand. But I think it's fair to say that we have enough supervisory power to do a reasonably good job in supervising these public banks. There is a dedicated unit at the MOF who is also supervising these public banks indirectly, especially in terms of their mandates and also financial performance as well. We have an independent committee comprising of quite credible people from the business sector. It could be former bank executives, people from the academia. They work out a set of KPIs with each public bank. And then annually, these public banks are evaluated by a local credit rating agency against the KPIs that have been agreed upon, and bonuses are decided upon their performance. The KPI, 60% of it is about financial performance. Another 40% is about enablers such as IT development, HR issues, and also very interestingly, the remedial actions taken in response to the corrective orders prescribed by the Bank of Thailand. So I think it's quite a credible process to make sure that even though we don't have all the supervisory power, there are other setup such as the MIFs, so the MOF's dedicated unit and the KPI setup, the evaluation process that makes it very credible that these banks will have to perform in a good way, so that they get the reward as well. So the last point I'd like to talk about, mention about the public banks is that when there's any losses, they are on a separate book. They can do commercial lending, but also by the mandate, they have to make policy loans as well, and this will be on a separate book. Losses that come out from policy lending will be on the book of the government, and they will be compensated by budget in the following year. Yeah, so this is the brief description of the public banks in Thailand. Now, coming back to your question, the autonomy, what are the challenges so that we can get more autonomy in supervising public banks? It's a very difficult and challenging issue. Well, if you look at the supervision of the private banks, I believe that most supervisors have complete autonomy in supervision. They can formulate the rules and regulation and enforce them. And when there's a need, they prescribe prompt corrective actions. And when the board, the management are not doing well, they can order the change. So these are very important for the supervisor to do a good job to make sure that banks are safe and sound. But when you look at public banks, usually it is rather rare for the supervisors of public banks to have similar clarity in terms of the legal mandate, in terms of operational mandates. And they are usually not given a full range of supervisory power, supervisory tools. And even if they are given some tools, maybe in reality it's difficult for them to implement, to enforce them as well. So it's very important that we must make sure that the public bank supervisors have the same autonomy as the supervisor of private banks. Usually they are the same supervisor, but they are subject to different set of laws and set of practices. So it's very important because public banks actually can be riskier than a private commercial bank. If you look at the concentration risk, someone mentioned this point earlier, and because of the mandate. And from the prudential point of view, the supervisor may want to set up more stringent, limit for concentration risk. But if the law is not clear, if the law has not given the full power, then it could be it could be taken that this is an unfair competition against private banks. So it would be difficult for the supervisor to impose to make such a difference. So that's why it's rather important that these have to be clear. Also, in some countries, well, in fact, even in the case of Thailand earlier, different public banks are under different ministries. For example, Agriculture Bank used to be under the Agriculture Ministry. The SME Bank used to be under the Industry Banks. And that role is to oversee the mandate of these banks, not focusing on the prudential issue. So when there's a conflict from the prudential side, does it mean that the supervisor will have to get consent from them? If this is not clearly spelled out in the law, it will be rather messy, and you can see that the coordination could be a huge issue. So it goes without saying that complete autonomy is as for public bank supervisor is as important as private bank supervisor. And so for that, I think we have to work hard to make that happen. And the challenge is that it's the lack of the supervisory authority's independence. If the head of the supervisory authority can be easily removed by the minister, by the government, then it will be difficult for that authority to fend off political pressure or political interference. So it is the same logic as central bank, independence in carrying out monetary policy. It's an area that I think we need to try to convince to make that happen. Another last point that I want to mention is that there could be an issue of the lack of financial independence. If the authority has to rely on government budget for its supervision, and if the government decided not to give enough budget, no suboptimal level of budget, then it could create the resource problem for the supervisor, both quantitatively and qualitatively. I'll stop here.
Thank you, Teresa. Indeed, I think you have highlighted some of the additional challenges that regulators or effective regulation would face in light of these publicly owned banks. Now we have talked about all the challenges. Let's talk about policy response to mitigate risks or to try to tackle these challenges. Let me start with Jonathan this time. Can you share with us your views on key features of effective supervision of public banks, please?
Thank you. I think a good starting place is the Basel core principles for effective banking supervision. While there may be some features of the core principles that do not easily apply to a state-owned bank, which often has a specific policy objective, I think for the most part, these principles form a good foundation for supervision. One difficulty, one challenge is that the state banks may not be subject to normal market pressures. The emphasis on maximizing return on capital, maintaining depositor confidence, or controlling and diversifying credit risk. That is, I think, a key difference between public banks and at least some public banks and private banks. For this discussion, I'm going to focus on banks that have been set up to carry out government-mandated policy objectives. And as an aside, if a private bank has been nationalized or put into a conservatorship on a temporary basis until it can be sold or liquidated, I think it's clear among all of us that such a bank has to be supervised under the same prudential standards and regulations as a private bank. But for banks that are state-owned and are seeking to meet a need not met by private banks, and where possibly a government ministry such as Kundrisa mentioned is exercising some control over the bank's operations, I want to highlight 4 areas of supervision that I think are particularly important. And one of the challenges of being on a panel like this with such an expert group of panelists is that I'm going to repeat much of what has already been said. I'd like to emphasize first that supervisors and the bank's government owners need to have an accurate picture of the performance of the bank, the quality of its assets, its contingent liabilities, and the sustainability of its earnings. To the extent a state-owned bank is viewed as having a government backstop, it will lack the important early warning signs that are provided by the market, such as depositors or creditors demanding higher interest rates to offset increased risks in the bank. Therefore, there needs to be a straightforward requirement and obligation on the part of the state-owned bank to publish accurate and detailed reports on its performance. These reports should be produced on a timely basis, at least annually, and should be made available to the public. A related element is that the supervisor should have the resources and authority to ensure that a bank's assets are assessed and properly valued, and that the bank has established adequate loan loss reserves. As important are rules requiring bank management to track and report on their management of NPLs and to prevent banks from continuously rolling over problem loans. This can be tricky when the sector of the economy in trouble has lots of political support. Another element is for the supervisor to have a well-defined mandate and clear supervisory objectives. There should be no ambiguity in the power of the supervisor over the state-owned banks. The exercise of supervisory judgment is important when supervising private banks, but it may be that supervisors of state-owned banks should operate under a regime of clear rules that provide less room for supervisory discretion or judgment. A benefit of clear and explicit supervisory rules is placing an opportunity for political interference in the way that the supervisors carry out their examinations and take enforcement actions. And its previous panelists have mentioned prompt corrective action. An important feature of these rules is that there are objective triggers that limit supervisory discretion and requirements that a supervisor take prescribed actions against a poorly capitalized bank. This is highlighted in the IMF staff paper, which stresses that supervisors need to have the legal authority to undertake corrective action and to sanction public banks, even when such actions are contrary to the views of the government as shareholders. Supervisory powers mentioned in the paper include the ability to suspend dividend payments, restrict the activities of the banks, and replace management and board members. While I'm in full agreement with this principle, I wonder how many supervisors of public banks are realistically able to take such actions. If my concerns are correct, this raises the question, and again, this is something that Teresa mentioned, what are the concrete recommendations that might be made to resolve this problem of lack of independence? What steps can be taken to give supervisors the independence required to take such a politically sensitive action against banks, even when opposed by politically powerful constituents? Thank you, and I look forward to our future discussion.
Thank you, Jonathan. Indeed, that's a big question mark, how to ensure regulatory independence. Teresa, right now we see an extraordinary confluence of crises putting pressure on sovereign debt sustainability. The so-called sovereign bank nexus is even stronger for state-owned banks than for private banks. What are the key policy priorities for authorities to address this sovereign bank nexus challenge? Please.
Thank you. Well, the sovereign bank nexus is about the interdependence between the sovereign and banks, and vulnerability in the one sector leads to vulnerability in another sector through a number of channels. Just one simple example, the macroeconomic channel. Say if a weak sovereign needs to do fiscal consolidation, that will send the contractionary impact to the economy, impacting also the balance sheets of banks, both quantitatively and qualitatively. And then this will further, worsen the economic situation. And so it comes in a loop, coming back to the sovereign sector. Well, this is a very simplified version. In reality, there are many other details, factors, and also directions are usually both ways, not just one way. But I want to highlight the fact that this interdependence is stronger between the government and public banks, because public banks are either funding arm or policy arm of the government in making policy loans. So in the same example, in addition to the mechanisms, transmission mechanism that I have just outlined, the public bank as the policy arm will have less funding for the government. So this will, aggravate the impact, the contractionary, the impact of the macroeconomy. While the public banks who are policy arms, because of the worsened the economic situation, loan qualities are likely to go down, and then there will be losses, more higher losses incurred, and this will go back to the government as the budgetary cost, again aggravating the government's budgetary position. So this is a very serious issue, and we definitely need to think of a way to try to, mitigate this interdependence and also mitigate the potency of the feedback loop between the two sectors. And basically, we need to improve the resilience in both sectors. On the government side, well, this is not the topic of our discussion today, but I'll just briefly say that the government will have to adopt, fiscal discipline in formulating their budgets, with a focus on the prioritization, on the efficiency and sustainability. It's a long process, but there's no other the easy way out. On the issue of the efficiency, I like to just give a thought with relation to public banks. Instead of asking or requiring public banks to make more policy loans, perhaps it's more efficient if public banks lend together with private banks in a risk-sharing scheme, supported by, say, Credit Guarantee Corporation, which I believe exists in most developing countries. And if the risk-sharing scheme is designed in the right way with enough incentive, then banks will be willing to participate in such a scheme and make loans as well. So in essence, we get more loan, both from the public banks and also the private sector bank. And the benefits also is for the public banks as well in terms of learning experience, because private banks are in general better in managing risk and also better in analyzing a credit. This will be beneficial to public banks. And because of the, tagging along with the private banks in making loans, the loan quality should be better. And the cost that will eventually become the losses of the government sector will be lower. So it's a win-win situation, good for the economy, good for the public bank, and it's a way of improving the efficiency, the effectiveness of government budget as well. So much for the government sector. Now, turning to the bank side, the issue is, well, this is more or less very similar to what Jonathan has just said, and also I mentioned earlier as well, that banks would need to have, bank supervisor will need to have the autonomy so that they can properly supervise banks and make sure that banks are safe and sound, and that will improve the resilience of the banking sector. Apart from that, there are a few more points. For the public banks, another policy priority is that they must have the right governance structure and also the right reward system more or less similar to what I said earlier. If the board members are fit and proper, have the right expertise to contribute to the organization, to the bank, this will be fantastic. The bank will no doubt improve in its resilience. And we need to make sure that public banks are properly and adequately supervised with additional supervisory tools. And last point I'd like to make is about transparency. Right now, I think we all expect that when with the increase in lendings and also bad quality loans during the pandemic, it's generally expected that when all this forbearance is withdrawn, both the private banks and also public banks will see a big hole in their balance sheet. What do we do with that? It's going to be a very big issue. It's very important that the authority make a full assessment of the financial health of the banking sector, both private and public, and then take into account all potential impairments that can be anticipated. And if the recapitalization need is huge, it's okay. We understand. I mean, investors understand that it's impossible for any authority to recapitalize all these public banks with such a number. So it can be phased in over a few, say, accounting periods. But the important point is that the schedule has to be pre-announced. This will increase, restore or maintain trust in the banking sector. It's critically important. I like to emphasize that. So improving resilience of the public banks, in fact, both private banks as well, will go a long way in mitigating the sovereign bank nexus and also the potency of the feedback loop as well. I'll stop here.
Thank you, Teresa. Very important point on transparency. I think Jonathan also highlighted the importance of transparency as well. Alexandre, many problems in public banks can be associated with corporate governance weaknesses. How do you think that strong governance and risk management could be ensured in public banks? How do you think that the government ownership should be organized and managed? Please.
Thank you, Bo. Let me just first react to a comment made by Teresa in the previous round and also reinforce this round and by Jonathan as well, which is the need for the autonomy of the supervisors to supervise public banks. I think this is an important issue that we need to secure that, and I subscribe to this principle and the need for this. I would like to raise two issues related to the issue. Even if you have autonomy, independence for public bank supervisors, I think we need, and the report does not emphasize that, I should say, I think it's a point that could be emphasized in the future, is that we need legal protection for supervisors and resolution authorities when dealing with public banks. Importantly, because in this case, we supervisors are subject to legal action by other government entities, and even when acting in good faith. So, for instance, as we mentioned here, the need for recapitalization, if the supervisor has the independence and require this from the public bank, you might have the accounting courts jumping on you, even if this is done in good faith. So I think legal protection for supervisor and resolution authorities is very important, especially when dealing with public banks. The second issue, which is a bit different, is that even if you have independence, I think you have a high level of skepticism from stakeholders that supervisors sort of don't deal with public banks the same way they do with private banks. So there is some lenience there in the perception of stakeholders. So I think in some instances it might be justified in the past in some jurisdictions. However, I think supervisors having the autonomy to supervise public banks, they know this perception, this latent perception. So they end up doing their job, and by doing their job, you have the kind of backlash from the shareholder, which is in this case the national treasury, the government, saying that you are treating the public banks in a much more strict way than you do the private banks. So this is a very fine line that the supervisor, I think, even with independence, they will have to tread when supervising public banks. So going back to your question, I think there are three potential problems associated to public banks. First, the issue that they could be a means to circumvent the government budget, as we mentioned before. Second, that they may be reluctant to collect debt for political reasons after granting loans. Third, that the management may operate without proper controls, building empires, delving in activities that it doesn't understand. And this almost invariably is followed by large losses, as we know from international experience. And I believe truly that these three problems can be solved. I think that the report does a good job in addressing these issues. I think, first of all, we need very clear mandates that specify the purpose that these public entities are supposed to serve. And as importantly, I think what they should not do, I think should be explicit what the public bank should not do. Second, they need a clear governance framework. There should be rules about relationship with the government and in Congress to prevent mandate overstretch and cronyism. There also needs to be a clear financial separation between the balance sheet of the public bank and the government or the public finances. Public banks must be able to stand on their own feet, manage their risk, and build their own reserves. And as I said before, top management should be subject to the same requirements as that of the private sector peers. So fit and proper process and hiring and dismissal procedures the same as private banks. And third principle, I think bailouts must be difficult and very difficult when dealing with public banks. There need to be clear rules when and under which circumstances the government, the shareholder, are allowed to provide more capital to these entities. And I think this is a view, a principle to prevent the soft budget, the use of this as a means to circumvent the budgetary process. So, and misallocation, reckless behavior, so on and so forth. So conversely, I think public banks should be covered by deposit insurance and resolution schemes at similar terms as the private sector peers. But as you said, Chair, this is it's easier said than done. I think this is a very difficult, perhaps the most difficult proposition that there is in this paper is how to resolve a public bank where the shareholder is the national treasury. Of course, market participants, on the other hand, think that there is an implicit guarantee, and if this support does not come, it certainly has huge repercussions in the financial system going beyond the public banks themselves. So potential contagion is the word here for these extreme events to have to resolve a public bank. I think it's important to prevent things from going wrong in the first place. And in this regard, I think regulation and supervision are so important. And we need to have the capacity to require prompt action, early action from public banks. In Brazil, the first act of my administration there in 2011 was to pass Resolution 4019, which basically defines all the requisites that we can ask from the banking system, including public banks, including the two large federal commercial banks, like preventing distribution of dividends and other early action measures which are to be applied. But certainly, I think the most difficult issue that this report addresses is resolving public banks that are fully backed by the national treasury the same way we do with private banks. I think it remains to be seen, and this is a very long shot. So I stop here, and thanks again.
Thank you, Alexandre. Very pertinent points. Now let me turn to Vero. An issue that arises where public banks have a large presence is the risk of an unlevel playing field between private and public banks because of different legal frameworks, deposit insurance arrangements, and so on. So let me ask your opinion on this. What should be the policy priorities to ensure a level playing field, and what are the key challenges?
Thank you, Bo. I would put it in sort of two ways. First and foremost, I think that you do need to strengthen the legal framework for giving the supervisor and the regulator the right powers over the public sector banks. I think all the panelists have emphasized this. Because I think without a legal backing, essentially, you basically get the finance ministry and whoever is in charge of managing the public sector banks looking for regular compromises. I want to say quarterly, but it's not even quarterly. My experience was it's daily. There's like some concession or the other that they want on a pertinent basis because they know that the central bank has no legal authority to say no. The central bank doesn't have a legal mandate that it can appeal to refusing a request that's coming due from the government. And I think it hits fundamentally at the issue of rules versus discretion. In my experience, while rules versus discretion trade-off is always there in central banking, the ability of a large player like the government, which you could even argue ultimately is the quote-unquote owner of the central bank in terms of recapitalizing it when it gets into a problem with its balance sheet. But, you do want it to be operationally independent, just like a judiciary or a tax authority or an invigilation authority. And I think if there isn't a legal clarity that the central bank can follow a set of rules in dealing with public sector banks, in my opinion, depending on how muscular a particular government is, how constrained its financial condition is, how attached a particular bureaucracy and finance ministry are to using the public sector banks to support state elections, national elections, I think it's just a ticking time, just before disaster, because at some point they can push on the central bank to get discretionary outcomes. And I can guarantee you from my whatever I've seen for 50 years of India that they will. And there's little that the central bank can do at that point. So that's one. I think the legal clarity is the most important. And I would actually push the IMF on this quite a bit. I think the last FSAP for India did actually make a very strong and clear point on getting legal reforms undertaken in India for public sector bank reforms. And I think perhaps the IMF should, given your report, should take it up even as a bigger agenda across different countries. I think the second point I want to stress, and maybe this will be a bit controversial, but I have great clarity about it at my end, so let me just make it, which is that in some sense, the beauty of the public sector banks for bureaucracy and the government is that you can actually postpone having crises for a very, very long time. Like until the national balance sheet reaches the brink of collapse, you can postpone a crisis that's coming from a public sector bank. Now, this is not to say that that's not costly. In fact, I would argue it's even more costly. It's better to have a crisis. Crises are very often the times when significant financial sector reforms take place. Imbalances have been brewing for a while. A crisis happens, and then for once politics and economics align, and then you get some reforms, significant reforms of the financial sector. Dodd-Frank Act, with all its imperfections, is, I think, a case in point. But there's now growing research in academia which shows that banks lead to costs for taxpayers, banks lead to allocation inefficiencies, even if they are silently suffering. As long as they are undercapitalized, they do terrible things. They don't have incentives to lend well. You throw in bad governance and regulatory capture or political capture on top of that, and you get even worse outcomes. So, where am I going with this? Where I'm going with this is that, in my view, it's also the onus is also on the technocratic central bankers to actually raise these issues during the times when they are in their public jobs. Sometimes the tendency of technocrats in central banks is, oh, I have to do my regular day job. I have to do a part of my legal mandate well. So let me just not confront these issues in my day to day dealings with the government. Let me just strike compromises. Yes, and I have to or turn a blind eye. You either turn a blind eye or you strike compromises because you think during my term I have to achieve whatever the best I can given the legal mandate I have. Of course, there are many technocrats who don't necessarily follow this approach, but I think that uh, a string of technocrats doing their job, each in a narrow space of making these compromises, actually leave their countries with a fairly bad outcome stitched together over periods of time. I see compromises done by central bankers in India over long stretches of time as having given sort of fairly compromised and terrible banking sector outcomes over the last 5 decades. Of course, if you raise a voice, if you push for advocacy on reform of public sector banks, if you push openly for legal reforms, that's going to be difficult. It can lead sometimes to you not having the right relationships with the finance ministry. In extreme cases, it can lead to a loss of job. But my sense is technocrats should embrace these risks, and I think they have to do what is right for the long run legal mandate. They don't have to necessarily do what's right for the legal mandate within their terms. So I think what I'm overall saying is that rules versus discretion and legal reforms are key. The technocrats and multilateral agencies such as IMF, World Bank probably need to work together in order to ensure that the reforms are in the right place for the respective countries.
Thank you, Vero. Very important point. Legal clarity and also responsibilities of central bankers and technocrats. It's not easy, but I agree with you. We need technocrats to be outspoken and to play a more proactive role in pushing reforms, including IMF, our own economists. I think we need to continue to be candid and to be more proactive. Well, time runs very fast. I want to turn our last question that I will ask all panelists to spend 1 or 2 minutes with your quick answers, if possible. And the question is this: do you see the public banks as having a special role to play in guiding the response of the industry in the more forward-looking issues? For example, those relating to addressing the climate-related financial risks, as well as broader environmental issues and risks. So I want to start with Teresa, then Alessandro, then Vero, and finally Jonathan. So I want to go that order. Start with Teresa. 1 to 2 minutes, please.
Thank you. Well, definitely the public banks can play a big role in this regard. In fact, the Agriculture Bank has already started. They have a program to promote smart farming. So they have certain qualifications for people to come along so that they can get the loan in order to, to have new technology to modernize the farming sector. And the agriculture bank can do so because they are specializing in this particular area. They know where the weaknesses are. They know how to get rid of how to help promote new technology so that we can increase the efficiency of the agricultural sector. In fact, the dedicated unit that I mentioned earlier at the MOF is promoting, asking all public banks to come up with a proposal to launch some sort of the lending project in order to promote ESG issues. And I think this is something, well, the central bank as a regulator will probably have to step aside. We can support from behind the scene, but the initiative have to come from at the MOF because they are focusing on the mandates, and this is an issue about mandates for the public banks. Of course, central bank can support very strongly from behind the scene because central bank is also promoting private banks to engage in ESG issues as well.
Thank you, Teresa. Alexandre, please.
Yeah, absolutely. I think all public banks should have a special role. I mean, without a special role, why we need public banks? Maybe leave it for the private sector to deal with them. But I think the important thing here is what should be this special role for public banks. And here we can borrow the principles from public economics to define state intervention. One, I think public banks should address market imperfections. You mentioned one. I think here in Latin America, countries, we have the regional and social reach of private sector banks sometimes is very limited. So there is a role to be played by public banks to address sizable proportions of the population that are unbanked or underbanked, I should say. And you might have the case also, as you mentioned, and I think quite importantly, private lenders may pay insufficient attention to climate change or environmental risk, so the public banks have an example to give in this area. The second principle is that the cure must be better than the disease, right? So the public banks should do no harm. They should add in terms of resolving the economic issues of a country. They should fulfill their purpose without becoming, as we discussed this morning here, a major drag on public finances or crowding out private sector solutions. So I think there are other means to address issues, but if these two principles are attended, then I think there is a role for public banks to play. Thanks again for having me.
Thank you. Vero, please.
Yes, I think I'm just going to reinforce some of the messages already conveyed, which is that as long as the contours of the uh, function and intervention through a public sector entity for issues like climate change or agricultural security for a country are well specified, I think it can work well if there are preset budgets by the government so that the scope and scale of what these entities will do is ring fenced. I think these are the public sector entities that do well. I think when these contours are not very clearly laid out and the budgets become sort of state contingent rather than being laid ahead of time, I think that is when the mission creep comes in. Like in India, for India, there's a very nice paper by Sean Cole at Harvard Business School where he shows that India's agricultural lending cycle is perfectly coincident with the election cycles in India. And of course, you could continuously say that public sector banks are serving some particular sectors. But as long as the scope for mission creep remains, I have no doubt that ultimately that function will get politicized and start serving national or state election interests of the current parties in play. So I think I would say as long as contours are well specified, it's okay to involve public sector entities in agendas such as climate change. But I think if the governance of a country is too weak to ensure that the contours will be adhered to, I think this is just going further down the slippery slope of what public sector banks have been able to do on basic functions of financial inclusion and lending to the real sector. In that case of weak governance, I would rather prefer that let's not add to the mission creep that we've had with public sector banks before figuring out how to deal with them well in the first place in regulation, supervision, etc.
Thank you, Vero. Jonathan, you have the last words.
Well, I agree with all of the previous comments. I was viewing this more as a question of should bankers and should bank supervisors be concerned with climate change and the environment. I guess my take on this is if governments wish to showcase the benefits of all banks addressing the environment, climate change, then state-owned banks should take the lead in the banking industry and incorporate the environment and climate change into their risk analysis and lending operations. It's tough for governments to talk a lot about climate change if banks they control are not incorporating these issues into their lending. And again, thank you very much for inviting me to be on this panel. It's been great.
Great. Well, to conclude, I would like to thank our panelists for this very rich and interesting discussion and for their openness in sharing their experiences and views. Today's discussion provided useful food for further thought as we work to ensure the safety and soundness of public banks and their ability to contribute to the economic recovery. As we have heard today, public banks may play an important role in mitigating market failure and broadening access to finance, but their ownership structure, mandate, and other specific features can create unique risks to financial stability and public finance. Hence the importance of an effective regulatory, supervisory, and crisis management framework. A key takeaway from today is that ensuring effective arm's length governance structure between owners and management of public banks need to be given a high priority. Indeed, many banking problems are associated with weaknesses in corporate governance, and our panelists' experience confirm that there is no different for public banks. But even more importantly, mitigating risk of public banks requires a holistic approach, some elements of which are well beyond the control of prudential authorities. Legal and regulatory framework, independence and power of supervisory and resolution authorities, and critically, political will are all necessary ingredients for sustained success. I would add, actually, that there are historical reasons for many of the public banks to exist in many of the emerging markets and developing countries. But as market matures, as conditions started to change, I think authorities need to reflect on what are the conditions for the existence of such banks. How can we make it better? And is the risk of government failure bigger than the risk of market failure? And if so, what are the reforms we need to make our banks, including the currently public banks, to make them safer and more efficient? I think all these issues we need to consider, and our authorities need to consider. There is no doubt these are challenging issues, and we at the IMF are ready to continue to assist to help our members to tackle these challenges going forward. I want to thank our panelists again this morning, and wish you all have a good day, and hopefully we have other chance in the future to continue our conversation. Thank you very much.